Guys, Joel Frank here, market analyst for YouTrading. Apologies for my crackly voice. I do have the flu at the moment, but I'm trying my best to still be audible and understandable. But anyway, in this video, we're going to quickly be doing a market update, looking across some of the major asset classes, and then we're going to be talking about the week ahead and some of the major themes that are at play. So, let's jump straight into the charts here. I've got the DXY 1-day candlesticks here. You can see it's just pulled back from hitting fresh, I think this is actually multi-decade highs. So if we put it on a 1-month candlestick, yeah, actually on this chart, it doesn't even go back far enough. But yeah, it's pretty much the DXY is at multi-decade highs, just around 108, 109. You can see euro dollar hovering around that parity level. It's actually been there for the last couple of days, with the upside in the DXY actually more driven by a recent move higher in the dollar yen, which is also back near annual highs. You can also see sterling or cable has been getting battered, now around 117, its lows for the year. So all of these factors sort of helping to support the dollar at year-to-date highs. In terms of other asset classes like equities, you can see we've had these big moves lower recently. Like we had a big 3.6% drop on Friday. That is a big 1-day decline. And we'll talk about the reasons for that in a minute, but it was basically because Powell was hawkish last Friday. And then just quickly, oil, some sort of immune to the recent drop in risk assets and the dollar strength, because there's some oil specific things going on at the moment, which we'll talk about. But pretty much, let's go back to currencies, and let's talk about the Fed and Powell last week. Okay, pretty much his message was a big pushback against the idea that the Fed is going to be cutting interest rates next year. Powell pretty much reiterated what a lot of the other Fed officials before him had been saying, but he pretty much talked about how interest rates are going to have to continue rising, which we knew, but then they're going to have to stay at elevated levels for a longer time in order to ensure that inflation is coming back to target. Obviously, Powell's the big dog at the Fed, so, when markets were getting that message from the other Fed officials in the days and weeks before Powell, it had been supporting the dollar. You could see that we'd been having this push higher from mid-August lows, but then we hit those fresh annual highs in wake of Powell, confirmation from the big dog himself, basically. Now, in terms of dollar yen, we've had some moves in US bond markets, which have been quite interesting in response to Powell's latest commentary. Like the 2-year yield is trading or recently hit its highest level since I think people say 2007, above 3.4%. And you also see an upside across the US Treasury curve. Remember, the yen is sensitive to rate differentials. Okay, so when you do see US interest rates rising, well, Japanese interest rates tend to remain very close to zero because of the Bank of Japan's yield curve control policy. So that basically hurts the yen. So there is potential for more upside, I think, in dollar yen and potentially the broader dollar because, we've got Fed officials who have recently been talking about how they want interest rates to go to like above 4%. Yet you've still only got the 2-year yield around 3.4%. So it seems to me like that 2-year yield could get a bit higher, okay? And maybe even the 5-year yield as well, which is around 3.25%. But if these sort of moves are to happen, then dollar yen might be in for some further gains. Of course, all of these developments might not be good for stocks. You can see, remember, we sort of were talking about when we hit resistance a couple of weeks ago in this area. We hit the 200 DMA, which is there in red. We hit this downtrend. We also were overbought in terms of the RSI. We talked about that in a previous video. So yeah, now the S&P 500 now hovering close to 4,000. So that's quite a big pullback. How big is it actually from the recent highs? Yeah, it's like a 6.5% pullback. If the Fed is sounding this hawkish, people might be asking, shouldn't we be back to these sort of June, July lows? Well, it could potentially happen, but remember, compared to back when we were at these lows, The US economic data, or the jobs data and the ISM data that we got anyway for July, was better than expected. And we've had multiple indications that US inflation has peaked, and we had the earnings season, which was much better than expected. Okay, so those three things sort of mean that we're probably justified holding above 4,000 for now. But let's jump into the calendar because we've got a lot of important US economic data today. And if that comes in very weak, then that could remove one of those three factors that are supporting stocks above their June, July lows. So we've got, I mean, we know consumer confidence is going to be bad because of inflation. Then we've got jolts. Then we've got ISM manufacturing PMI and then jobs data. Now, I'd be sort of watching this ISM manufacturing PMI. And then actually, if you just go next week, then you've got the ISM services PMI. But I'd be watching these two as one of my important ones to watch this week. Because if they weaken substantially, then that could create doubts about the durability of the US economy at the moment. Because recently they've been quite strong. Look at this, 52.8 in July. And let's just go to next week's. Oh, it doesn't have it on, but it was about 57. But the alternative PMI measure in the US, the market PMI, has been much weaker and in contractionary territory, indicating the US economy that's perhaps in recession. So, which of these stories is true? I think there's a risk that these ISM numbers are going to come out weak, and then that could weigh on equities because if weak data means a more dovish Fed, then that can be good. But we've just had the Fed saying that they're not going to be dovish. And another thing the Fed talks about is the fact that they're willing to actually tighten through a recession because they're so concerned about inflation that they will take that weak economic growth. Friday's jobs data, that's going to be obviously key, as it always is every month. Um, in terms of the inflation narrative, it would be a positive to see these jobs numbers easing a bit because US labour market's been very tight, which is inflationary, and we're potentially hoping for that from the jolts as well. Um, hoping for that, I mean, if you want to see inflation easing, obviously not good if you're looking for a job and the jobs market isn't as good as it once was. In terms of other economic events, Eurozone flash CPI for August. That's always an interesting one. Obviously, Eurozone in the midst of this horrendous energy crisis, which pretty much means that the continent is already in stagflation. These are all themes that could continue to underpin the dollar next week. Aside from that, keep an eye on Fed speak. Got a couple of members, Brainard, Mester talking, Williams as well. But yeah, that's pretty much it, guys. That's what I'm thinking about for the week ahead. Hope you enjoyed the video, and I'll see you all in the next one.